Welcome to Voyage Daily Tech, the most important news personalized for you every day, supported by Voyage.com.
All right, we've got 5 fascinating tech stories lined up for you today. First, a rogue investment firm is selling backdoor access to SpaceX shares, and they're doing it without the company's permission. Then, we'll cover a stark warning from OpenAI about its biggest Chinese rival, which is racing to build a global, non-American AI empire. After that, a new US Senate bill is aiming to strip power from the SEC and potentially unleash a new wave of Wall Street crypto investment. We'll also look at why Nvidia's CEO is cashing out nearly $1 billion in stock right at the peak of the AI boom. And finally, we'll wrap up with the alarming rise of fast tech, those cheap, disposable gadgets creating a staggering electronic waste problem. A startup is now selling access to shares in SpaceX, and they're doing it without the company's permission. The investment firm, Republic, is offering tokenized representations of the private space giant, effectively creating a backdoor for everyday investors into one of the most exclusive deals on the planet. And here's what's turning heads. The price of admission. Forget the typical $10,000 minimum reserve for accredited investors. Republic is letting people in for as little as $50. However, if you zoom out, you'll see another layer of strategy at play. The company plans to expand this model to a who's who of private tech titans, OpenAI, Stripe, X, and even Waymo. This move aims to blow the doors off the pre-IPO world that has been off limits to the public for decades. So how are they pulling this off? Republic's co-CEO Andrew Durgee went on the record with a statement that is a direct challenge to the establishment. He said, "We don't need a company's approval to be able to do these types of offerings." He added that companies are going to have to question how they're going to approach some of these innovations and how far they will want to push that risk envelope. This isn't happening in a vacuum. It comes as the US crypto industry tests new regulatory boundaries, with giants like BlackRock CEO Larry Fink predicting the tokenization of every financial asset. Coinbase and Kraken are already making similar moves, signaling a massive shift in finance. The entire gambit is built on securities laws from the 1930s, repurposed for the digital age. But it raises huge, unanswered questions about legality and oversight. It leaves you wondering, when you create a public market for a private company, who is really in control? Speaking of tech giants pushing boundaries, OpenAI is making headlines today, but not for its own success. Instead, it's for a bombshell report on the stunning rise of its biggest Chinese rival. The company is Zhipu AI, and according to OpenAI's own analysts, it's making major moves to secure government contracts around the world. Backed by a staggering $1.4 billion in state investment, Zhipu isn't just building technology, it's executing a calculated global strategy. OpenAI itself delivered the most chilling, quote, warning that Zhipu's goal is to, quote, lock Chinese systems and standards into emerging markets before US or European rivals can. This isn't a future threat, it's happening now. Zhipu is already providing sovereign large language models, often in partnership with Huawei hardware, to governments in Malaysia, Singapore, the UAE, Saudi Arabia, and Kenya. They're offering a complete non-American AI ecosystem. But that's not the whole picture. The real turning point is that this is all happening even as Zhipu AI sits on the US Commerce Department's export control list, which is meant to bar it from procuring American components. Despite the restrictions, its global push is accelerating. This sets the stage for a direct showdown. While Zhipu expands its influence, OpenAI is running its own OpenAI for Countries initiative, racing to help governments build their own AI capabilities in coordination with the US. It's a high-stakes battle for technological dominance with the world's emerging markets as the new front line. So the big question is, as nations choose their AI partner, are we witnessing the fracture of the internet into 2 competing AI worlds? And who is winning the race to define the future? This battle for technological dominance has massive regulatory implications. And on that note, let's turn to the world of crypto, where a major battle is brewing in the US Senate. A new bill just dropped that's a direct challenge to the most powerful crypto regulator in the country. The proposed legislation would fundamentally change the rules of the game, taking a huge amount of power away from the SEC and its chair, Gary Gensler. This is being called a big reversal of the current administration's plans to clamp down on the industry. Here's the core of the conflict. The bill aims to define whether cryptocurrencies are commodities or securities. If they're deemed commodities, crypto exchanges could register with the much friendlier Commodity Futures Trading Commission, effectively sidelining the SEC. And as Washington signals a potential ceasefire, the market is exploding. Bitcoin just blew past the $105,000 mark. This is where the situation takes a more complex turn. It's not just about day traders anymore. The biggest names in finance are placing massive bets. The crypto firm Digital Asset just raised $135 million. The investors? Goldman Sachs, BNP Paribas, and Ken Griffin's Citadel Securities. Wall Street's titans are officially embedding themselves into the crypto infrastructure. And, it's not just about regulatory shifts. The endorsements are coming right from the top. The CEO of Robinhood just went on the record saying this kind of regulatory clarity is crucial for the US to regain its lead. Even Visa's CEO confirmed the credit card giant has been embracing stablecoins. The regulatory walls appear to be coming down, and the largest financial institutions in the world are rushing in. It all leads to this. Is this the moment crypto finally sheds its outlaw image and becomes the new face of finance? So while Wall Street seems to be rushing into crypto, one of the biggest names in tech appears to be cashing out. The man at the very center of the AI gold rush, Nvidia CEO Jensen Huang, has just kicked off a plan to sell stock worth over $870 million. This isn't just a small trim. According to a new filing, Huang has a plan to unload up to 6 million shares of Nvidia through the end of 2025. At recent prices, that's a jaw-dropping $873 million stake. The first transaction is already done, with Huang selling nearly $15 million worth of stock in just 2 days. This move comes at a moment of unprecedented success. Nvidia's stock has been on an absolute tear, skyrocketing over 800% since OpenAI's ChatGPT burst onto the scene. The company's GPUs are the undisputed engine of the AI revolution, with revenue recently jumping 69% in a single quarter. So why is the founder selling now? While the transactions are part of a prearranged plan, the scale and timing are impossible to ignore. This follows another massive sale last year, where Huang cashed out about $700 million in shares under a similar plan. It raises the question of whether this is a pattern of taking profits at the peak of the hype cycle. And while Nvidia appears unstoppable, it is facing growing headwinds. The company is navigating complex export control issues that could potentially limit its access to critical foreign markets for its AI chips. To be clear, Huang's personal stake remains immense. He still owns more than 800 million Nvidia shares and has a net worth of about $126 billion. So the move really makes you ask, is this just a founder diversifying his portfolio? Or is the man who saw the AI boom coming now signaling that the absolute peak is in sight? From the high-end chips powering the future of AI, we're now shifting our focus to the other end of the hardware spectrum, the world of cheap, disposable, fast tech that's creating a massive environmental problem. Let's start with a single statistic that might just change your entire perspective on consumer electronics. Spending on so-called fast tech has quadrupled to a staggering £11.6 billion since 2023. Think fast fashion, but for gadgets. Experts are sounding the alarm with a stark warning. We had fast food, then fast fashion, now fast tech. This is the world of cheap, disposable electronics, and the demand is exploding. Last year alone, this trend fueled the purchase of over 7 million battery-powered minifans. And that's not all. Nearly £8 million was spent on novelty items like light-up toilet seats and mini karaoke machines gadgets, often bought on a whim and quickly discarded. The true cost, however, is hidden in what we throw away. Surveys suggest that over half of all this fast tech ends up in the bin or abandoned in what one report calls our drawers of doom. A previous analysis found that our collective tech junk could contain over 38,000 tons of copper, critical and valuable material needed for the global transition to low-carbon technologies. The problem is, these gadgets are often a toxic cocktail that is very hard to recycle, according to Greenpeace. The combination of cheap plastic and complex electrical components not built to last or be repaired creates a massive waste challenge. When this electronic waste is thrown away, it often ends up being dumped on poorer countries. It forces us to confront an uncomfortable reality. In a world chasing the next cheap thrill, what is the real price of a £1 gadget?
That's it for today on Voyage Daily Tech. Follow, share, and stay tuned for daily updates coming your way tomorrow.